BlackRock CEO Larry Fink is planning on opening up private markets to millions of everyday investors. It is the next step to transform BlackRock into the first firm to manage money at scale across traditional and alternative assets. Joining us now, private equity reporter Allison McNeely and Bloomberg Intelligence financials analyst Neil Sipes, who covers BlackRock closely. Allison, I want to start with you because this annual letter from Larry Fink was quite poetic. He talks about a prosperity flywheel, and he opens the door to unlocking private markets. Now, one holy grail of that would be to bring in private assets into the 401k plan. You wrote about this recently. Is this a likelihood in the next 4 years?
It's certainly a realistic possibility. Larry Fink sounds like many of his large asset management peers, whether they're on the alternative side or traditional side, in sort of talking about the necessity to bring private assets to individual savers like 401k retirees. Really, there's an industry-wide push on both the traditional and alternative side to get access to those funds.
So, as Shonali spelled out, there's a lot of poetry in this letter. Of course, Fink took his time to wordsmith that. But I want to talk about the cold capitalist reasons why BlackRock might be interested in really expanding aggressively into private assets. You know, they have trillions of dollars when it comes to ETFs. A lot of them are passively managed. It's not like you get very fat margins on passively managed index funds.
No, you certainly don't. And that's a trend you've seen across broader asset management is, of course, fees declining. Most prevalent is, of course, those passive products, the beta type products. So ultimately, when you think of BlackRock, that's what you think of, that traditional legacy business that's grown to nearly half its franchise. But obviously, the other side of it is assets near 12 trillion now. The fees are the different story for those passive products. And really, when you look forward, where the fees are going to be is those alternatives in private market space. You think about passive products are 25% of all global assets under management. Alternatives are also a quarter of assets, but alternatives are half of revenue, and passive is less than 10% of revenue. So you think about the difference in the story there. It's no secret why they're interested.
What's interesting to me, the many ways they've tried to do this. You and I, Katie, have covered a lot that private credit ETF from Apollo and State Street. For example, there are interval funds being offered by the likes of JP Morgan and slowly everybody else, it seems like. Allison, you've covered these products so closely, the interval funds as well. BlackRock now putting private assets into the model portfolio, getting access to financial advisors as well. What's taking off? What are the ways that are actually working to retailize private markets?
So far, we've seen products that offer quarterly liquidity as opposed to daily liquidity.
Those interval funds.
Yeah, interval funds be the ones that are kind of getting the most uptake right now, I guess. That's largely because those structures are already in place and have been in place for longer on the wealth side. But certainly everyone is working quickly and furiously to try and solve this daily liquidity problem or question, I guess, to say, you know, what happens to some of these assets that, you know, are not generally valued on a daily basis, are not bought and sold on a daily basis. How do you put those alongside stocks, bonds, other daily liquid assets? That's a puzzle that I think the industry is still trying to figure out. There may need to be some regulatory changes or at least some regulatory clarification in order to make those products really take off.
Well, we saw an early answer from State Street and Apollo, but if you take a look at interest from actual investors, I mean, PRIV is the ticker for that private credit ETF. It's only seen 2 days of net inflows. It launched over a month ago, so it seems like investors taking a wait and see approach. As Allison mentioned, though, you have a lot of the brightest minds in finance trying to solve this problem. It's interesting that we haven't seen a pile-on from issuers. BlackRock, for example, hasn't filed for a private credit ETF. I mean, how do you at Bloomberg Intelligence think about these different wrappers as we talk about this really aggressive push by the likes of BlackRock into private assets?
Yeah, I think what we hear from most managers that we follow is they want to be vehicle agnostic. They want to be able to provide the solution to the client, regardless of whether it's a mutual fund, interval fund, ETF, whatever that might be. The one that we've seen rolled out recently has a 70 basis point expense ratio. So we're obviously talking about a different fee structure when you think of a traditional ETF. Again, that speaks to the attractiveness of the product for the manager. We haven't necessarily seen, as you noted, the uptake yet. We're still in the wait and see period. I think that's a big hurdle right now is sort of the education of these products, how we're going to get that liquidity, how advisors are going to explain that to the end client as well. and ultimately how that's going to fit in the broader portfolio where you have Larry Fink talking about the 50-30-20 rather than the 60-40.